Good afternoon and a very warm welcome to each and every one of you. I'm Neil Brown and I'm the head of Anchor Asset Management. And thank you in advance for spending your time with us today. We really do appreciate it. Most of the big issues affecting societies, economies and markets since last year are still with us. And it's certainly not clear when they will be resolved and replaced by the next set of challenges that we'll all need to deal with. There are always lots of challenges that abound. The team today will share Anchor's views on the issues currently affecting markets the most, explain how we've taken these into account in our investment process, and as a result, how we are positioned to make our clients money over the next year. First off will be Anchor Fund Manager and Co-CIO Nolan Wapenaar. He will share Anchor's asset allocation views and then cover the fixed income asset class. Nolan will be followed by Anchor CEO and Co-CIO Peter Armitage, who will cover global and local equities. Nick Dennis, the fund manager responsible for the award-winning Global Equity Fund, which has been nominated for and won multiple industry awards, will then provide insight into those areas of the global markets where he is currently seeing opportunities. During the course of events, our analysts Lelethu Poswa and Seleho Tsatsi will share some of their insights as well. We will have a Q&A session at the end, so please post any questions that you have in Zoom's Q&A section, which should be at the bottom of your screen, and we'll endeavor to answer as many questions as possible at the end, time allowing. We will distribute a recording of this session a day or two after the event, once the editing has been done. And for those of you who require CPD points, the CPD certificates will be distributed once they've been accredited by the FBI, which normally takes about a week or so. So without further ado, I'd like to hand you over to Nolan.
Thank you very much, Neil, and hello, everybody. I appreciate your dialing in on what is a shorter week or a shorter work week to listen to Anchor's views and for the latest edition of Where Will the Money Be Made. I'm going to be talking for the next 20-25 minutes or so. Many of you will already know me. I'm Nolan Wapenaar, Co-Chief Investment Officer, but really my day-to-day job is I am responsible for fixed income at Anchor. So I'm going to talk about all products that generate fixed income or interest income, and I will then hand over to Peter to talk about the equity side of the world. In that context, I just want to start by talking about what's changed since our last view, since we've spoke to you a quarter ago. And the biggest change that is actually taking place in the markets is maybe over a longer term period is rising interest rates. And if you look at interest rates in America, for example, back in 2020, interest rates were essentially zero. Today, they're between 4 and 5%, depending on what you want to look at. Domestically, interbank rates were 3.5% back in 2020. Today, they're up at 8%. We've seen a massive increase of base interest rates. We'll get into the whys in a few seconds, but that is having a knock-on effect across the investment universe. Specifically, two key changes I want to look at is that it is making income products or cash-like products a lot more interesting. Back in 2020, it was very difficult to get excited to invest for a 0% or 0.2% return. Today, actually, cash is an asset class that needs a little bit of attention. As interest rates have been rising on cash and on risk-free assets, it's also then been pushing up the sort of expected hurdle rates on other asset classes to make them interesting. So you're having a bit of a sort of shuffling of asset classes within our asset allocation mix. The other point I will make is, if you think back to what we said a quarter ago, not that much has changed in terms of our economic outlook. So what you hear today is going to be broadly similar, I think, in terms of expectations for what the future holds. Perhaps the one difference is that depending on which asset class you look at, you've had a pretty decent first quarter and you've had positive returns. The consequence is that we're starting from a higher base, and therefore the outlook is maybe a little bit softer in terms of expected returns. But overall, it is a positive environment. Investment environment. We have positive expected outcomes across all asset classes. I think the outcomes are actually in line with long-term averages. And therefore, from our perspective, we actually think that now is a good time to be invested, possibly with a couple of nuances. If we look through and dig into the weeds and the detail, What you will see on our domestic asset allocation is that we remain neutral on equity, slightly positive on bonds. Basically, on a risk-adjusted basis, we think fixed income gives you a slightly better outcome, even though the absolute returns are lower. Listed property, we're a little bit cautious on, and cash has been upweighted because of the higher interest rates that are available to a more neutral stance, while we remain positive on alternate assets. Looking globally, we've seen a very strong first quarter from global equities, and as a result, we've just sort of taken the foot off the accelerator a little bit and moved towards a more neutral stance and maintained our neutral stances across most asset classes. The higher volatility in the environment right now, coupled with higher interest rates, actually makes alternative asset classes, hedge funds, structured products, etc., quite an interesting topic for discussion as well. Overall, I think the sort of key takeaways are it's a positive investment environment, and I wouldn't make major changes to my portfolio from the last quarter. Specifically, though, let's dig into global yields and let's look at what's been driving global yields higher. We've been talking about this for the last year and a half, actually, and it's been about inflation. And as inflation sort of rose, we've seen interest rates chase and to sort of catch up, and ideally to see inflation come down. But if you think about what we were talking about 18 months ago, it was about used car prices, it was about airline tickets, it was about shipping costs, it was about technology chips for use in various products, and supply chain blockages. We're not talking about that anymore. And instead, what has happened is that the focus and the drivers of inflation has shifted. And what's driving inflation today is shelter costs, effectively the cost of rent or owning a house, and that's the sort of key driver. Coupled with that, we've actually seen wage pressures, particularly across the United States, but more broadly across most of the globe. And these wage pressures, again, are the key driver of inflation. Now, that's not great, because if you look at shelter costs, if you look at wage pressures, those are the types of inflation that are stickier. It takes more time. It is more difficult to get that inflation back down to where you want it. So as a result, the nature of inflation has changed towards sort of items that are more inflationary, more longer term inflationary in nature. The good news, though, is if we look back to 9 months ago, inflation in the US was at 9.1%. That dropped down to 5% at their last reading. So it is very clear that inflation is on a downward trajectory. Inflation is coming back to more realistic levels, which is very comforting for financial markets. But in that context, we've got to be aware that many of the stickier inflation items that I've just been talking about means that as this trajectory of inflation goes downwards, it's going to sort of become more and more difficult for inflation to drop. And most of the inflation models I'm looking at are actually saying that inflation is probably going to fall to about 3% and then sort of hover around there. The problem is the US's target is about 2%. So from that perspective, that raises a couple of questions I'll deal with in the next slide. Looking at the right-hand pane of my slide here, the other aspect of the global markets that we need to be aware of is the sort of fragmentation of global markets and animosity between nations. If we think about the last decade, it benefited greatly from globalization. And basically what you had was cheap Chinese labor using American technology to produce goods that were actually becoming cheaper and cheaper. As a result, globalization was quite deflationary. Unfortunately, with what's going on in the world right now, the benefits of globalization are, if anything, slightly in reverse. And this in itself is one of the other factors that's keeping inflation a bit higher, coupled with obviously some concerns as to the broader outlook for the globe. So in this world where inflation is pulling lower, but it's kind of getting to 3%, what is going to happen? How do we see this? And what I've got here is a chart which shows you the yield on US 2-year bonds. And you can see how in 2020, as I said, the interest rate was essentially zero. and the interest rate on those bonds has risen quite starkly over the last 18 months, and then it's pretty much broadly sideways since about October, November last year. The issue is that where to from here? And if I go and look at what the Federal Reserve is talking about in their statements, they're basically saying, yes, we're moving in the right direction, but we're not done yet. Maybe 1 or 2 interest rate hikes, and thereafter quite a protracted period where interest rates move sideways. So they stay higher for longer. If I look at what the financial markets are pricing in, they're basically saying, if I look at the yellow arrow, that interest rates are likely to come down. And they're projecting interest rate cuts starting from the end of this year. It becomes very difficult to judge now. Is the Fed right? Is the market right? And the reality is probably somewhere in between. So what does this really mean for us? It means that between these two scenarios, interest rates are probably broadly sideways, gradually tracking down. And that means we're actually going to be in a positive fixed income environment. We're going to be in a positive bond environment where you're going to be earning very attractive yields for a longer period of time, coupled with potential capital gains at some point. So from that perspective, as an investor, I'm actually looking at this going, yeah, that's a nice outcome. So to sum up our perspective on global yields, cash has become interesting. At 4-5% yields, you've got to look at cash as an alternative investment within your portfolio. There are very few hikes left, maybe one in a week's time from the Fed, but really we need to start thinking about interest rate cuts. We need to start thinking about how to position for interest rate cuts. And in that regard, holding some term yields, some term bonds, sort of bonds maturing in the next 4 to 10 years is beginning to look increasingly attractive to lock in these higher rates for a longer period of time. We like the Anchor Global High Yield Fund. It's currently yielding between 5.5% and 6% in US dollars. The bonds are all maturing in 2026. So that's what we favor within the fixed income environment globally. Turning to our eye on the domestic world, the first question that we keep getting asked is, we've seen a number of bank failures. We've seen Silicon Valley Bank, SVB, fail. We've seen Credit Suisse fail. We've seen other US banks fail, Republic banks sort of seeing some significant outflows. What about South African banks? If we look at our South African fixed income portfolios, there's a significant proportion of Anchor's products that invest in SA banks. In fact, probably 50% of the portfolio is lent out to the big 5 banks. In that regard, the question that I keep getting asked is, well, what is our risk of a bank failure really hurting a South African investment portfolio? So I thought to do something different today. What I would do is ask Lelethu Poswa, who is our head of credit here at Anchor, just to join us online and to talk about Silicon Valley Bank and to contrast that with South African banks. Hi, Lelethu.
Good afternoon, Nolan.
Lelethu, good afternoon. Thank you for joining us. In the context of what I've been saying, looking at Silicon Valley Bank, what actually happened there?
Thanks for the question, Nolan. Good afternoon, everyone. During the pandemic, Silicon Valley Bank, commonly known as SVB, received a lot of deposits from tech firms. The bank took these deposits and bought a lot of bonds. These bonds were bought at a time when interest rates were low in the United States. As interest rates rose in 2022, the value of these bonds declined significantly. Deposits started to leave the bank in 2022 as many of these tech firms were negatively impacted by higher interest rates and needed their cash back. In order to pay back the deposits, the bank decided to sell the bonds. The bank sold the bonds. When they sold the bonds, they took big losses as the value of these bonds had declined significantly. When the bank announced its plans to raise funds to cover these bond losses, shareholders and depositors freaked. Shareholders sold their shares and depositors all went to the bank at the same time to withdraw all the deposits, a classic bank run. When SVB was unable to pay back the deposits, the regulator and the central bank, Federal Reserve, stepped in, closed the bank, ensured the deposits and eased market stress by providing some degree of financial assurance.
Thanks, Lelethu. So very much your classical bank run sparked by losses on the investment portfolio. Looking at the South African banks, how are South African banks structured? Are we likely to see a similar outcome here in South Africa?
The big four South African banks are positioned differently from Silicon Valley Bank in a number of ways. The first difference is in the deposit base. Most of SVB's deposits came from tech firms, resulting in SVB being highly exposed to shocks coming from the tech space. SB banks are different, as the deposit base is well diversified with a good mix of household deposits, corporate deposits, and financial sector deposits. Furthermore, the deposit mix has been broadly stable over the years with no historical evidence of a bank run in South Africa. The second difference is in the asset base. Most of SVB's assets were in long-term bonds, which declined in value as interest rates increased. SA banks are different as most of the assets are in the loan book portfolio, which contains the bank's home loans, vehicle loans, credit cards, and overdraft facilities. The interest income a bank receives on these assets increases when interest rates increase, resulting in a better profitability position for SA banks. Performance of these assets has been better than expected despite low economic growth, intensifying load shedding, and high levels of unemployment. The third difference is complying with international banking standards. Given its small size, SVB did not have to comply with some international banking measures. For SA banks, it's a bit different, as a reserve bank requires all banks to comply with these measures. The last difference is liquidity. SVB became forced sellers of bonds that had declined in value. SA banks are generally different as they've got good liquidity positions. This is supported by sizable cash on hand, cash balances with central banks, and interbank balances. Should a SA bank experience moderate deposit withdrawals, it can rely on these balances without incurring any losses. Another liquidity source for SA banks is the ability to place government bonds as collateral with the central bank to get access to cash quickly.
Thank you, Lelethu. So to sum it up, what you're saying is it is very unlikely that we would see a similar scenario play out in South Africa, and consequently, we don't think that South African banks and our portfolios are exposed to some of the risks of that we've seen taking place offshore. And very much actually that is what played out in 2008. If you think back to the banking crisis, South Africa was somewhat more isolated from it. But if we say that the quality of the portfolio remains intact, then the ultimate question is, well, what's going on in South Africa? And let's talk about South African government debt forecasts for a second. So what we've got in the middle pane of the screen is South Africans' debt forecasts at different points in time. And basically, if you look at the red line, what it was saying is that in 2020, in the mini budget, the Minister of Finance was projecting that South Africa's debt to GDP ratio would rise to about 90%. At the time, we got ourselves downgraded. It was in COVID, and it was actually quite an ugly discussion. The next time the minister came to speak to us was actually in February in the 2021 budget, and the debt levels had then, expectations had then reduced to about 75%. And in fact, the next time the minister spoke, debt levels were a bit lower and a bit lower and a bit lower still. Each time, successive time, the finance minister came to speak to us. So what's really been happening behind the scenes is that from a fiscal restraint perspective, the country's actually been pretty well managed. And that our debt levels have been managed down to below where we thought we'd be. I think we've definitely benefited from commodity prices, but nonetheless, there's been a restraint in how we've behaved, and that has put South Africa on a far, far, far better footing than we thought we would have been. So that's maybe the good news. So the bad news, unfortunately, if you turn to the right-hand side pane, is it's not so much about the fact that our government's collecting taxes and actually managing the fiscal situation quite well. The issue is how the government is spending the money. And, Eskom is the sort of key case in point, where Eskom is obviously the single biggest risk factor, and it's weighing on our economy very, very heavily. Don't need to say too much there. But what I will maybe say is that the chatter, when I speak to professionals, when I speak to various people outside of government, is becoming incrementally more positive. And that's something that I actually needed to digest for a bit, because you wouldn't think so. But what is essentially happening is that the perspective is that, Eskom itself is very sick. And, I'm not for a second saying I believe that Eskom is going to be turned around and is going to be rising up to its former glory. But perhaps what the analysts are saying now is that, looking at what's going on in the country, you're seeing the private sector sort of fill the void that is being created by Eskom. Very much like the private sector has filled the void for airline, for air transport, with SAA largely dropping out of the picture. So as the private sector steps in, we're actually seeing quite significant changes. And Peter Armitage will give you a bit more detail in terms of numbers in this in a few seconds. But if you look at things like, the import of lithium batteries to store electricity, the volume and value of imports has shot through the roof. We've imported in the first quarter of 2023 something like 5 times what we imported in the whole of 22 and 10 times the imports of 2021. So there's a massive investment in energy, electricity storage. Similarly, we're seeing similar sorts of trends developing in solar panels. In fact, even if you look at the number of projects that have been announced or approved in terms of investments in renewable sources. So from that perspective, maybe the private sector is able to fill the void that is being created as Eskom comes under pressure. Overall, though, looking at South Africa, what we've got is, the ultimate question as an investor is, should we buy South African bonds? And the way we look at South African bonds is we take, a fair value of South African bonds. Starting with a brown bar at the bottom, we just add we take the US 10-year yield, which is readily available. We add to that the sort of red bar in the middle, which is the value or the cost of buying credit insurance on South Africa. So the cost of insuring for that things might go wrong. And then finally, the blue bar on top, there's an interest rate differential between the rand and the dollar that we add to this. You add the 3 of these together and you end up with a fair value of a South African 10-year bond. Right on top, you've got the jagged line. That's actually where the South African bonds are trading. And the point I'd make is, firstly, optically, our fair value is sort of in line with where the bonds trade. So it's actually working quite well. But if you look right on the right-hand side, you'll see our fair value is touching South African bond yields. From that perspective, we actually think that SA bonds are about fair. They're not screaming cheap. They're certainly not a screaming buy, but they are fair, and you're being adequately paid for your risks, for the risks that you're taking in South African bonds. Looking at that, remember I said a minute ago when looking at global fixed income that we are moving into a positive bond environment. Doesn't matter if bond yields go sideways or if they come down, that is positive. One's a bit more positive than the other, but the outcomes are all very good. So from that perspective, we expect that to spill over to South African bonds, notwithstanding some of the domestic challenges. Again, domestically, fixed cash-like products are very interesting. Our Anchor BCI Core Income Fund is yielding over 9% right now, with actually very, very low risk. And a lot of investors are liking that as a sort of place to park investments while we wait for more direction from the global environment. The environment is positive for bonds. We've already discussed that. So overall, probably a good outlook. Before I hand over to Pete, I just want to talk about the rand itself. In the South African rand, Anchor subscribes to the purchasing power parity model, which basically says that the rand and the dollar should behave in accordance with the inflation rate differentials between the two currencies. So as the South African inflation generally is higher than the US inflation, we would expect the rand to depreciate historically by about 4% per annum. At the moment, though, if we look at the sort of jagged line, which is actually where the rand is trading versus our sort of projected value, it's very clear that the rand is trading quite a bit weaker than our projected value. A lot of that is actually a sort of Eskom discount, if I can put it that way. And I think, the models I've seen have been saying that the rand's about 10% weaker than where it would be absent Eskom. So in this environment, the question is, will the rand pull back to its fair value? And to be honest, we're not totally convinced it will. I think that a more likely scenario as this plays out is that our inflation rate will gradually bring the fair value a bit higher. It's almost like the model will catch up with reality. Maybe the market is sort of forward-looking, is how you could look at this. But in that context, we think that, the dollar has been overly strong. I think the dollar will probably give up some of that strength, but the propensity of the rand to benefit from that has reduced. So we've modeled for the purposes of our asset allocation on a 17 rand to the dollar in a year's time sort of target, which is basically saying that, yes, the dollar will probably give up some strength, but the rand is going to continue to sort of be a little bit lackluster in the context of the domestic challenges. So summing it all up from my side, it's still a positive environment. I think the risks are adequately priced, and I think there is good upside within fixed income, both domestically and abroad. And with that, I'm going to hand over to Peter Armitage to ask him to talk you through the equity side. Thank you.
Thank you, Nolan. There you've got a bit of a backdrop in terms of equity alternatives. And I'm going to talk through the equity side of the world. I think Nolan's given a lot of background to what's happening out there. I'm going to add a bit of color. And of course, we look at things a bit differently from an equity and fixed income perspective. I think, the base case for fixed income is the yield, which, as we're seeing, is about 5% offshore and about 9 to 10% locally. Equity doesn't always give you that kind of return, but obviously the upside potential is significantly higher from time to time. And the excitement and the DNA of our business is when we can find a share which goes up 20, 30, 50 or 100%. That's really when we feel smart, and that's what creates happy clients. But I think this presentation and the theme of what we do in these webinars is to talk about macro and kind of globular expectations and global expectations. And I think to summarize from a starting point, from a domestic equity point of view, we're neutral. And when we say neutral, we are comparing that to other assets that are available out there. So in the context of a core income fund yielding 9%, a bond fund yielding 10.5%, you've got to be pretty bullish on equities for them to be aggressive, because you'd want to be compensated for the additional risk that you're taking, and you'd be wanting to get kind of a 15% odd return. So we do think you'll get a reasonable return from equities as a whole. Our official number on the table that Nolan showed you is about 11%, with about 5% of that coming from dividends. So it's not actually forecasting dramatically higher numbers. This year, global companies like Naspers, Richemont, Bidcorp have been the stars of late. Richemont has been a fantastic share, and global luxury goods companies have done incredibly well. And then I think we must also remember that while the US is probably going into a mild recession, the second biggest economy in the world, in the form of China, is really coming back quite nicely. And most players are looking for 5 to 6% return from GDP growth from China over the course of the next year. So there's quite a good story with SA banks. There's quite a good story with the global companies. We think there's some quite nice conditions still. During the course of the year, we think resources will come back quite nicely. But for the 30 to 40% of the market, which is represented by SA Inc-listed companies, it's obviously been very tough going. So you're seeing our retail companies trading at the lowest multiples in many years, and they're obviously under a lot of pressure. But you're sitting in a classic value situation with companies like a Mr. Price, the lots of the other apparel, construction, etc. But the question is obviously whether they're in a value trap. So they're very cheap, earnings multiples are low, earnings are under pressure, and sentiment is poor. So there will be a time, and if one is clever from a stock picking perspective, there are opportunities there, but we're certainly not diving in right now. But then if, the light's on the end of the tunnel, and I think it's a very appropriate phrase that, is that private sector electricity investment will be a big boost. And I'll talk a little bit more about that on a forthcoming slide. From a global perspective, at the beginning of the year, we said we thought the S&P could get to about 4,400 by the end of the year. That was a fairly bullish statement compared to most of the big investment banks out there. And it's done about 10% over the course of the first kind of year to date in the first quarter. So it's done quite a bit of, the offshore markets have been nice, quite a bit of recovery, but obviously still well below where we were at the beginning of last year. And we still think you'll get a pretty good return over the course of the next 12 months. But there's still a lot to play out. And we certainly have been and are going through a period in global markets where it's treated where bad news is good news. In other words, the whole banking crisis hardly made the market budge, and the market took the positive, glass half full type of perspective in saying that, well, that means that they can't raise interest rates too much more, and we can see our way through to the end of the cycle and declining interest rates. So that kind of mood doesn't last forever, and I think that's the risk of some more impacts of high interest rates coming through is what's stopping us from being wildly bullish. So we do see a very nice positive return for people with global equity portfolios. We'd maintain our exposure in selective companies. We'd continue to invest. But I think we're just cautioning that you can't increase interest rates by the fastest in 35 years without some more unintended impacts. So some of those will be surprises. We don't know exactly what they'll be. But ultimately, if, with long-term money, we think markets are sitting in a nice place. If you're willing to see through these kind of potential risks and bumps, the interest rate peak is certainly in sight. Nolan's run through that. And longer duration assets are becoming interesting again. What we mean by that is companies where a lot of the value, because they're growing, a lot of the value sits kind of in the earnings numbers 3, 4, 5, 6 years out. And if you look back to 6 months ago, the market dismissed growth completely, and a lot of the growth premium on the market disappeared. And what that really means, that's kind of, we tried to be fancy in economic terms. What that really means is the share prices of the tech companies went down. There's been a big recovery already, but we think as interest rates continue to decline, $35 years. And this will lead to some consequences which aren't entirely predictable. The big thick line there shows what we mean and puts it in the context of other cycles. And that leads through to inflation. I thought you guys who follow these kind of investment talks will have seen a million inflation graphs. The most interesting one for me, and thank you, our generators do work, is the English breakfast basket. And you can see for many, many years, kind of sitting in the 25 to 29 pound. And this is probably for 5 or 6 eggs and not just 1 or 2. But you can see the dramatic impact coming through in a country like the UK, where inflation's running at close to double digits. There's been some numbers above 10%. And that's creating implications that are quite difficult to predict. I think on the other side of it, what we must remember is the world gets more and more technologically advanced. And I thought it was very interesting when Elon Musk put this graph up, projecting a 50% decline in the price of entry-level electric vehicles. Vehicles are a big part of people's expenditure over time. And he thinks over the course of the next 5 years, and you've already seen some price cuts coming through. So there are a lot of things that do naturally pull inflation down. And it's, the food and the services segment that's pushing it up, that will come to an end. So just kind of putting it in context from a growth point of view, America, which is 25% of world GDP, we see this year at close to 1%. That number could go negative in the second and third quarter. But importantly, China, which is the second biggest economy in the world, growing at 5.2%. And that's part of the reason why we remain fairly positive on the SA market. Obviously, SA was a fantastic place to be on a relative basis in the stock markets last year, as it outperformed global indexes quite materially. But more than 50% of the earnings in companies in our market are influenced by China, more than South Africa. So there's quite a nice boost there. You know, we're talking about companies like the commodity companies, Richemont, Naspers, etc. So the question really, you know, and we try and look at our crystal ball, is whether the S&P reached a bottom back in September, October last year. It's always nice to look at things in context. The S&P peaked at 4,800. It bottomed at 3,600. So that's a 25% decline, and which measured by historical kind of numbers is quite significant. And we've come back to the kind of 4,100 level. So, you know, with a target of 4.4 at the end of the year, that's not dramatically up. It's still below the beginning of this year. But, you know, with interest rates having gone up to the extent that they have, it's certainly going to have a negative impact on some companies' earnings. And the earnings season coming up will be quite important. So the risks are quite high. There isn't too much of a valuation cushion. We're very happy to be invested and stay invested in good quality businesses with sustainable earnings growth. And I think this graph probably sums it up for me more than anything. Ultimately, for those of you who own your own private businesses, the valuation of a company over time generally tends to reflect its earnings growth. What this chart shows you, the dotted line, is the trend US earnings growth of about 8% per annum. And the blue bars are the actual earnings numbers. So what it's showing you, as we've seen in the red box, is the earnings growth on the S&P for 2022 and projected for 2023 is basically flat. And this is really what we've seen play out in the stock market, is when 2022 earnings being flat got onto people's radar screens, we saw the market come off. It was too high if earnings were going to go flat for 2 years. But we see earnings kicking up again in 2024 as the dollar plays ball with markets, as inflation starts to subside. Companies have really cut a lot of costs, and they're very well placed as demand comes back in 2024 on the back of declining interest rates. So, you know, if we knew what this chart looked like a year ago, I think most people would have thought, well, the market needs a bit of a breather. But if we look through the current cycle that we're sitting at, you know, if you look forward to 24 and 25, we should get back to trend earnings growth and hopefully trend returns coming through from stock markets. So valuations at the moment, this is the world index, the emerging market index, and the S&P. If one focuses on the forward P multiple, we're sitting at between 12 and 19 P multiples. So while people are being quite bullish and looking forward, the point that we're making is there isn't a hell of a valuation cushion, and it wouldn't surprise us if the market does have a bit of a wobble along the way towards a pretty decent return 12 months out. But if earnings numbers come through more negatively than are expected, there's every prospect of some more market volatility. This is a chart showing the MSCI World Forward P multiple. So you can see it's traded in this kind of range in the whole 2014 to 2019 type period. It traded in that range quite consistently. So we're not sitting at a deep discount, and that's because markets look forward. And they are seeing the end of the interest rate hiking cycle, and the market expectations are that inflation will come down somewhat. So what it boils down to, and it's a time for stock picking and quality. I think when one talks about quality, I think one of the most important aspects of quality is the ability to sustain earnings growth through challenging economic times. And we'd like to think we invested by and large in businesses which have the ability to do that. So, a lot of these conversations are about index levels, but ultimately we stock pickers, we put together share portfolios, and we want to buy and hold companies which can grow through the cycles. And when things look fairly uncertain, and what's uncertain is, how deep the supposed mild recession goes this year. So economic moats, strong balance sheets, the quality of management, the margin of safety and the price paid, and the longer term investment horizon is what informs our stock selection at a time like this. So a very busy slide, but I've circled here what I want you to focus in on. And the point is that not all economic conditions are negative for all companies. And in fact, any set of scenarios or situations can be negative for some and positive for others. In a high inflation environment, companies that can pass on price increases and maintain their GP margin, it's actually pretty positive for earnings growth. And that's your real quality businesses. What we wanted to show you here, we don't normally put up such busy slides, but the impact is enormous. Obviously, with interest rates going from almost nothing to 4.5% to 4.75%, banks' balance sheets, they're earning significantly more on their own capital. So here we show JP Morgan, the first quarter of 2023 against the first quarter of 2022, and their net interest income went from $6.9 billion to $21 billion. So if you go down to the earnings number, earnings per share going from $1.50 to $4.10. So a significant positive for the banks. And at a stage like this, the game that you're playing with banks is some very positive, very strong positives coming through, but it's the extent to which that is offset by increasing bad debts, which is the negative. And here you can see in the other red block, their credit costs in the first quarter of 2023 going up to $2.3 billion from about $1.5 billion a year before. So that's absolutely dwarfed by the increase in net income, but they are earning more than average at the moment. So banks, we think, do provide a nice opportunity. It might be a little bit early in the cycle to be going too heavily into them. So, and it's dangerous to always look at those kind of headline PE charts because you can reach conclusions that the whole market is expensive, whereas in fact, there's lots of sectors where there's a lot of value. So the two banks that we own of the big ones that we put on the chart here, JP Morgan Chase and Citigroup. And you can see from a valuation perspective, JP Morgan at a forward 9 PE and Citigroup at a forward 8. So fundamentally, and this is not suggesting where the prices will go, we think Citigroup is probably, JP Morgan is worth about $190 compared to the current $140, which is 36% up. And the one which we put in our portfolios in the last 6 months, Citigroup, the return on equity is still sitting at about 9%. Their target is 12 to 13%. And we do have a fair level of confidence they can achieve that. If they do so, it's a share whose value can go from $50 to $136. So even though we've had a nice bounce in markets, we still think there's lots of share-specific opportunities which can come through. So the shares that have done incredibly well this year, and not surprisingly, these were the shares that did badly last year, are the tech companies. People are prepared to start putting that growth premium back on tech companies. And you can see Netflix at 17% up to NVIDIA at 90% up, have been very good shares to be in during the course of this year. Many of them, we're patiently waiting for them to come back and rise over the highs of last year. But we'd like to think we're exposed to the ones that have got the sustainable growth. What's very important in global investing is to make sure that we've got exposure to innovation. And you can see, everybody knows the story of innovation accelerating, where AI and the like have taken the center stage from a publicity point of view at the moment, and ChatGPT and entertaining a lot of people. And what we've always got to make sure is that we're exposed to how to the positives of change, but also we've got to see how it can negatively impact some of the businesses that we're invested in. I think change is happening a lot quicker than ever in the past. In the chart on the left, it shows some of the phenomenons or big websites or businesses in the world, have taken kind of 2 to 3 to 4 years to reach 1 million users, whereas ChatGPT earlier on in the year only took 5 days. I think what's quite important, and the exposure we're taking at the moment in order to gain positive exposure to artificial intelligence, is the companies with big server bases. the computing power that's required in order to run AI applications is about 7 times what people are doing at the moment. So it needs people with a lot of capacity in the background. And that's your Amazon, Meta, Microsoft, Google, Alibaba. So while it sounds pretty boring, the big companies are the ones that we think will be the beneficiaries. And there certainly will be a second-tier universe that's created, which benefits and makes money out of AI. And we'll obviously want to have exposure to that. There's obviously lots of ways to invest in the future. And this is a Morgan Stanley chart on all the different ways that, through from hardware through to applications and the businesses that are exposed to them. This is the kind of approach that we take in terms of making sure we've got that exposure. So a company that is heavily exposed, somewhat indirectly, to artificial intelligence is ASML. It's a company that has exposure to this space where the share price hasn't run away this year. We do have exposure to it, and I'm going to ask our tech analyst, Seleho Tsatsi, to just talk you through that a little bit. Seleho, do you want to take the screen?
Sure. Thank you, Pete. Yeah, I think your second last slide was talking about different ways to invest in the future. And it's difficult to think of a better way to do that than through ASML. I don't think it's an exaggeration to say that ASML is one of the most important companies in the global economy. And really, one of the reasons why we like ASML is that it has a very unique position within the semiconductor space. So what ASML does is it produces what are called extreme ultraviolet lithography systems. There's an example of one on the screen. And these systems allow ASML's customers to produce semiconductors in a way that is cheaper and more effective or more efficient. So if you look at ASML's customers, we're talking about the likes of Intel, Micron, Samsung, TSMC. These are all the leading semiconductor manufacturers globally. And they all use ASML's equipment to produce chips at increasingly cheaper methods or delivery points. And certainly, Pete was referencing this. I think at the moment, we're all feeling that the pace of technological acceleration is itself accelerating. I certainly feel that way. It's a bit unnerving, but also exciting at the same time. But what's exciting about ASML is that increasing pace of technological change is good for ASML. So one obvious example is AI, which Pete touched on a bit. I think if you look at the growth that we should see in AI over the next few years, that growth is going to require more and more chips. And as a result, it's going to require more and more of the equipment that ASML produces. So as Pete said, it's a way to get exposure to that theme quite directly, perhaps without taking some of the valuation risk that you have in other businesses at the moment. It's all good and well for there to be a nice story, but it's always better if it's backed by actual financial performance. And that's definitely something we see with ASML. It's a very high return on capital, high margin business. And if you look over history, just over the last 5 years, they've been able to grow their earnings per share at close to 25% per year, which is very impressive. But even going back further out, if you look back to 2010, since then, they've grown their earnings per share at 18% a year, which is very impressive. And there's very few companies who've been able to do that at this sort of scale. So it's a business with very attractive historic financial performance. And that led to very attractive returns for shareholders. So you can see going all the way back to 2010, ASML's done really fantastically. I suppose one question that naturally comes up is the growth story all over for ASML, or have they matured or peaked? We don't think that's the case. So ASML has said that it believes its revenue base in 2030 will be between 2 to 3 times the size of the revenue base it just reported in 2022. So we think that there's still a nice growth story ahead for this business. And at the moment, we do have some uncertainty in the semi space. So ASML itself has said that some of its customers are delaying or holding back on orders. because for those customers, they're seeing some weakness in end markets, things like smartphones and PCs. We're currently going through a period of slow growth, or in some cases, we're seeing year-on-year declines in demand. We don't know how long this downturn is going to last. I think no one truly does within the semi space. But what we do know is, or what we do believe is that coming out of this downturn, ASML is really one of the best placed companies within the semi space to come out of this downturn. And also, if we look to that kind of longer term opportunity, we think ASML is one of the best placed companies to take advantage of this increasing pace of technological change that we're seeing at the moment. Thanks, Pete.
Thanks, Seleho. Right, guys, so that's the global perspective. There's lots of interesting opportunities. The world's changing. We go and find those. The market as a whole, there's going to be a lot of pressure on earnings. Interest rate increases are very high. It will impact some companies in ways that we can't predict right now. So we're positive over 12 months, but a bit of caution in the short term. I think quite a lot of good news is priced into the market. From an SA equity perspective, the first quarter in SA wasn't as good as the globe. What we've seen is gold, Naspers, Richemont, as I said, doing pretty well. But the South African component of the market is under a lot of pressure and really hasn't done well at all. I think if you look at the chart on the right-hand side, if you go through our top 10 holdings from a local perspective, there's actually quite limited SA-specific exposure, probably around 30 to 35% of the portfolio. And there obviously are businesses in South Africa that are doing pretty well. So we've got a one-year total return projection of 11%. That's not bad. I think most people would bank that if they got offered at the beginning of the year. But given that you can get 9 to 10% in interest markets, with the stuff Nolan was talking about at the beginning, we would kind of balance our exposure with new money. The SA market is cheap, but is it a value trap? I think it's going to take quite some time to come through. But there really are some great businesses out there that continue to deliver good results and take advantage of the negatives. The load shedding's had a huge impact on margins. A company like Pick n Pay, which generates about 2 to 3 billion rand of operating profits, their diesel cost is over 600 million rand. So it's reducing their profits by 30 to 40%. But load shedding and what's happened to prices is giving rise to opportunities. Private investment is happening. And there's some recovery plays. We think it's probably too early to be getting in them. But we think our portfolio in 12 months' time could look quite a lot different. And there will be opportunities, as there always are in stock markets. A picture of Eskom supply, again, lots of numbers and years. But if we just focus on 2025, which is sooner than we think, effective Eskom supply of about 25 gigs. And what's emerging at the bottom is the total other supply is estimated to be more than Eskom's supply within 2 years. Currently, that's sitting at 24 and 13. So the private sector, if indeed the government does allow them to contribute, as they're indicating, and there's been massive spending coming through. We hear consistently from the mining companies and the like. Anglo American alone, we had a chat with the Kumbi CEO the other day, and they said Anglo American in South Africa will be producing 5 gigs of power over the course of the next 5 years. And if you put that 5 in the context of the 25 that's being produced at the moment, there really is, and the impact of this on banks, the financing opportunity is about 1 trillion rand. That's about $50 billion. And to put that in context, South Africa's GDP is about $350 billion. So with every negative, there's a positive. The private sector is being allowed to play more of a role. And when that's unleashed, I think you're going to see a dramatically better situation as we look out kind of 18 to 24 months. So our current positioning in domestic shares is low. We're significantly underweight for the reasons that we've outlined. We've got a healthy weighting in rand hedges, basic materials. We kind of at weight, and we're sitting in our equity fund with about 22% offshore exposure. So from a current positioning, we now can go up to 45% offshore. We benefited quite nicely from the currency. One of the risks is, as Nolan indicated, the rand is pretty weak. It can come back quite a lot. But if things pan out as we indicate, and earnings, the reality of a poor earnings season over the course of the next 6 to 9 months offshore materializes, there will be some nice opportunities to increase the global component of our balanced equity portfolio. On the JSE, we've concentrated in large, best-in-class businesses. At times like these, one doesn't need to go fiddling around in below average quality businesses. And what's keeping us edgy? The questions we always ask ourselves: is it too soon to be getting into the really cheap trough multiple businesses? We think so, but we're watching that quite closely. Sasol's obviously been a massive disappointment, but on most people's numbers now trading at kind of a 3.5, 4p multiple. And we've retained exposure there and waiting for them to prove themselves. So I think that sums up where we think the money will be made. From a domestic fixed income perspective, that 9 to 11%, depending on what products you want to be in. From a global fixed income perspective, cash at 4 to 5% in dollars. And given that we think global equities are, have run quite hard in the very short term, for new money that we're investing, we quite comfortably wait a little bit with cash earning 5% in US dollars. For longer term global equity investors, there's some interesting opportunities. And we think it's been a comfortable space over the course of the last quarter. We think it might become a little bit more uncomfortable in the short term. But if you're looking at 12 months, we'll then be in a very different phase of the economic cycle, and earnings growth in the S&P, which is really the driver of global returns, should come back quite nicely, and lower bond yields also motivate for higher equity valuations. So that's the equity side of the story. And we'll pass it on to Nick Dennis, who will talk about his specific fund and how he's taking advantage of some of the trends that we've been talking about.
Great. Thanks, Peter. And good afternoon, everyone. So I'm going to talk about the specific opportunities that I see in global markets, 2 specific areas. But before I get on to that, I'm going to talk about what I'm like my own perspective on markets from a slightly different angle than you've already heard today. So if you're like me and you use YouTube a lot, or if you're on Twitter, or if you listen to the media, you watch CNBC or Bloomberg TV, your stream is probably overwhelmed with bearishness. So there's one channel that you can see on your screen is a channel that pops up in my YouTube feed, and all I see is doom and gloom. It's when is the recession coming? More likely it's the end of the US dollar. The Fed is too tight and the world's going to end. It's really is pervasive negativity, and really for good reason to a large extent, given where we've come from over the last few years. A sentiment amongst professional investors is also really in the doldrums. So what this chart just tries to capture sentiment. It's from a survey that Bank of America puts out, fund manager survey, and what you can see is that sentiment is pretty close to the all-time lows that we saw, in sort of even lower than the COVID lows in March 2020, and close to the lows we saw in sort of October 2008 and October last year. So quite often these, not always, but these lows in sentiment can be coincident with lows in risk assets. So yes, we know there's bad stuff out there, but this is really known and sort of largely positioned for. So from the same survey, you can see that these are professional investors, fund managers, mutual funds, hedge funds, etc., are really heavily underweight equities relative to their benchmarks, and also relative to their own history. and overweight cash. So they're conservatively positioned. Not only that, but they're really muted expectations for future share price performance from here. So, by and large, investors, in other surveys and polls, expect the markets to go down from here. And it's not just one survey, it's sort of multiple surveys that I'm seeing. Very few people expect any kind of rally from here, never mind a meaningful rally. And also, as it stands today, they have really very few people have plans to increase their equity exposure. Typically, what happens is that as the markets go up, fund managers tend to chase performance, and so you probably see this number go up if markets go up. And then another sort of indicator of positioning. This is futures data, and I sort of won't go into the mechanics of it, but this shows the positioning of speculators, and they are in the top chart, the top line where you can see the blue circles. Speculators are positioned as short or as bearishly positioned as they've been in the last sort of 10 plus years. And typically, these sort of bouts of excessive short positioning or pessimism tend to be broadly consistent with bottoms in equity markets, or short-term bottoms, not necessarily timed to the day, but sort of in the zip code of equity market bottoms. So you put all that together and you say, well, people are quite bearish. There's a lot to be sort of bearish about, but investors are largely positioned for bearishness and for bad outcomes. So from a contrarian perspective, this suggests that perhaps if anything goes even vaguely right, there's potentially material room to the upside. I think that would catch most people by surprise. And then turning to where I see specific opportunities in the markets, or broad categories where I see opportunities. The first is in the mid-cap growth space. So I'm not talking about the mega caps like your Apple or Microsoft, Google, etc., Nvidia. I'm talking about if you look a layer below, that's in the sort of $100 billion market cap or less kind of range. And one proxy that I use for this group is the ARC fund, which is run by Kathy Woods. And if you look at the chart, the bubble, to the extent that there was one, has completely unwound. There's no bubble left. There's nothing left to burst or deflate. I mean, this story has completely unwound, to the extent that I checked the price yesterday, and it's the ARC fund or ARC ETF is trading pretty close to the COVID lows. So really, to the extent that there was any excessive optimism and sentiment, that has been entirely washed out, and it's really done nothing since 2018. So that's really 5 years of nothing. And so in the Anchor Global Equity Fund, I have revisited and bought back into names that were previously very successful holdings for the fund. So one example is C, which is a e-commerce and gaming company from Southeast Asia, hence the name C. I started buying it back in sort of mid 2019. You can see that on the chart with the green arrow, and it was a 10 bagger for us. So it went up roughly tenfold from our initial investment, and then there were other buyers along the way, and then we sold in sort of late 2020, 2021, where it just seemed like the headwinds from inflation and upcoming tightening from the Fed was likely to be a material headwind. And so we sold at least one of our sales was on the red arrow, and we sold both before and after that point in time. And then really watched from a distance for the following year plus and then have started getting back into the name. And so I think it doesn't have to go back to the all-time high for us to make attractive returns over the next, say, 2 to 3 years. Still really positive on this name. Another example in the sort of networking and cloud space is a company called Cloudflare. Similar story. This one we bought later on, sort of more in the middle of the pandemic, in sort of later third quarter 2020. Did really nicely out of the name, and then sold out of it, and have recently revisited the stock roughly 70% of its all-time highs. And it's another name that I think that still has multi-bagger potential from here. One of the stories, so putting aside the fact that the bubble has really completely burst, is a bottom-up earnings story. So during the years of the pandemic, the story was all about growth at all costs, investing ahead of time to reach these massive addressable markets, which the companies did, and they focused on revenue growth above all else. Subsequently, the companies have become, because money is not as freely available as it was, companies have really had to tighten their belts, and they found religion with respect to costs. And so what this chart shows is the consensus or the sell side earnings estimates for the years 2023 and 2024. And you can see with the red arrow that the sell side really had to downgrade their numbers aggressively. But if you look towards the right of the chart with the green arrow, now that these cost-cutting measures are kicking in, their estimates of profitability are ramping right up. And I think once the revenue run rates, once we go beyond lapping the inflated COVID base, you're going to see revenue accelerating, and I think profits could really explode. And that applies for a whole cohort of mid-cap growth companies. The next area that stands out as an opportunity is China. Now, China is, for various reasons that are well known and well understood, it became a fairly hated country and asset class. But it's got to the point where many of the leading companies are trading at multiples that are, roughly a third of comparable US counterparts. And so you're at a point where, yes, there are risks with China, but from my perspective, the potential reward to risk ratio, or the potential upside relative to potential downside, is highly favorable. And you've also got you should have a positive economic tailwind from reopening, and also the central bank is providing liquidity into that market. And so I think you've got a window where there's potential for these assets to do really well. And so I've given the example of the three China's big three in terms of e-commerce. I think everyone will be familiar with Alibaba, which is the leading player in e-commerce. The two other names are JD.com and PDD Group, which is Pinduoduo, and they have slightly different emphasis in e-commerce. But these are all large, credible companies, and they're also all sitting on significant piles of cash. So there's no leverage concerns. These companies are all well placed to invest for growth. But similar to the US, they're also becoming a lot more disciplined in terms of cost. And Alibaba in particular and JD.com are taking measures to unlock value and to break into smaller pieces so that value can be realized in the market. And again, just to highlight how, really Alibaba, as an example, has gone nowhere since its IPO, roughly. So for 8.5 years, you've really seen nothing. So it is the complete opposite of over exuberance, and it's very, very similar story for JD.com. So again, to me, yeah, there's certainly China comes with risks, fully cognizant of that, but it's a setup where your reward, your ups relative to your risk is very favorable in my view. So to summarize, I think it's clear that yes, there's a lot of bad stuff which is in the press, in social media. It's claimed by just about every strategist on the sell side, and with good reason. But it's really known, and investors have positioned for it to a large extent. So to the extent that it does happen, you would think that the impacts are not going to be that severe. I mean, if you've already sold your stock, there's nothing left to sell. And so it's almost so bearish that it's bullish. And if the world, if this oncoming recession doesn't happen, if the US economy is more resilient, if China's growth provides a boost to the rest of the world, then there's potentially meaningful upside to earnings and perhaps for, if not equity markets as a whole, then for pockets within the equity markets. And to my mind, as I've shared, I think those two particular pockets that stand out are mid-cap growth companies and Chinese names. And so, yeah, I would like to leave you with perhaps an optimistic message. And I think a bit of optimism and a bit of patience, I think will be rewarded over the next, say, 2 to 3 to 5 years. I think returns could be quite attractive. And with that, I will hand back to Neil.
Thank you so much, Nick. Thank you for those of you who have already posted questions in the Q&A section. Please feel free to add more. I'm going to run through as many as we can deal with in the 20 minutes we have left. I'm pretty much going to take them from the top. So the first ones will be directed at you, Nolan, and Lelethu. I'm going to start off with a bit of a challenging question from Michael. How do you know it's going to be the last interest rate hike? This was said about 4 hikes ago, but still interest rates are climbing. It's surely a dangerous assumption to state interest rates won't go up much higher like the 90s, but for different reasons.
Hi, thanks, Neil. Thanks for the question. And the other guys are welcome to chime in as well. I think that what we have seen is that there are fracture lines appearing in the global economy as interest rates go up. So SVB Bank, for example, yes, I don't think that's a scenario that will repeat here in South Africa, but it was symptomatic of the fact that there are fracture lines appearing. Equally, we're seeing, we're definitely seeing inflation sort of track in the correct direction pretty quickly going forward. So, from that perspective, I think the fracture lines are a very clear indicator that you can only go so far before you create significant damage. And I think that message has been received by the Fed. Will interest rates continue to go up? Yes, I think there's a very high likelihood of a rate hike at their next meeting. And thereafter, it's kind of a 50-50. But they don't have an ability to go as far as they did. And then secondly, they also don't need to, because after the next hike, the US is going to have a positive real rate, which is really what economists talk about to bring inflation down. In other words, interest rates are going to be higher than the inflation rate. And that in of itself is also going to create a bit of a deflationary environment. So, you're kind of ticking a lot of the boxes that you would expect to see ticked to reach the end of the rate hiking, albeit, there are probably 1 or 2 to go.
Okay. Another challenging one from Paul. For you, Nolan, we sort of spoke about why we don't believe the same risks are present in South African banking system. But the simple question is, was there not a bank run on Sambo?
That's taking me back to my youth almost. Yes, there was a bank run on Sambo, sort of 2000s, early 2000s, if my memory serves. And a combination of sort of mismanagement and fear resulted in big withdrawals. I think the point is twofold. Firstly, in that context, regulations have moved a lot, particularly after 2008. So back in the day, there were no things like a minimum liquidity ratio and, the other liquidity requirements that have been toughened up since the Sambo days. So today, banks that are applying full Basel requirements are actually probably a lot better, in a better position than Sambo was. Point was made by Lelethu that someone like SVB didn't have those Basel requirements applied to them, whereas all of the South African banks do. So we're naturally in a different position. The other point I think we were trying to get across was to say that, look, if you look at our portfolio, it's got a lot of exposure to the big 5 banks in South Africa. Now, those banks are very diversified, far more so than Sambo would have been, far more so than SVB. And there's that diversification of product lines, diversification of existing deposits, and diversification of access to liquidity that are giving us comfort to say that, the bigger banks in South Africa, frankly, are well run, probably better regulated, and therefore we're very comfortable with these banks going forward. Add to that sort of Pete's view on guys like JP Morgan, which says a lot of these banks actually have a positive outlook.
Thanks, Nolan. Lelethu, one for you, talking about SVB Bank. Why would SVB Bank have bought so much bonds at the low of the market in the first place? Also, did they not think of a liquid cash reserve in short-term deposits instruments for possible client withdrawals? Is it basically just bad management of deposits? Or are there other reasons?
Thanks, Neil, for the question. For SVB, I think buying bonds is not a wrong thing. The mistake they made was buying long-dated bonds and not hedging them. So as of December 2022, the bank had no hedges, and they took a gamble that interest rates in America were not going to increase. Now, with them buying long-dated bonds and not hedging them, the portfolio duration was very high, and they took a big hit on their bond exposures because of interest rates that have increased. So it is a series of the types of bonds they bought and also not hedging that led to them not being able to pay for those deposits.
Okay, thank you, Lelethu. Nolan, 2 more for you. Word has it that Warren Buffett is taking a loss on some bank stocks, but selling many of them out. Does that perhaps spell some serious problems ahead? That's either for you or Peter. And then an easy one. Can you asset swap money into the global yield fund, or does it have to be invested in dollars?
Peter, I'm going to give the view on global bank stocks to you, particularly sort of given what you've just said. But in terms of the global yield fund, you have to invest in US dollars, whether you obtain them from cash that's outside of the country for a variety of legitimate reasons, or whether you acquire the fund through dollars that were asset swapped. Both are very workable. Pete, do you want to take the question on bank stocks ahead? And is there a potential for disaster looming, I guess?
Yeah, no, I think so. We think the US banks are very strong. In fact, the whole deposit crisis is positive for the bigger players, because if you take your money out of one bank, you've got to put it somewhere else. So the deposits in the bigger banks actually went up when the banks went through a bit of a wobbly. So I think the price to books of these banks are between 0.6. I think JP Morgan's at about 1.7. But they're earning returns. So if we look at JP Morgan, their target is a 17% return on equity over time. They're currently over-earning a little bit, as our banks analyst likes to say. But if you can invest in some assets that will earn a 17% compound return, you're going to be prepared to pay 2 to 2.5 times the value of the asset to get that return. That's the way to think about it. So the prices have been quite muted. They've given you a nice return this year, but the 12-month return is quite poor in line with global markets. As we showed in that slide, we think some really nice upside. They could come under some pressure with the rest of the market if earnings numbers come through and the economy is worse than expected. But that's really the time to pick up good quality business with high sustainable returns and healthy franchises. So I think everything we're saying, how we reflected that in our portfolio. We don't have massive exposure, but we've got healthy positions in JP Morgan and Citigroup, And given that potential upside, a lot of them on our watch list. And if the market was to go through a bit of a correction, it's probably some of the shares that we'd like to pick up. We also recently invested in Admiral, a UK short-term insurance business. Bought it. I think we bought and sold that a few times in the life of Anchor. Sentiment gets bad, people want to dump it, and that's the time to pick it up because we rate it as a very high quality business. We don't pay too much attention to what Warren Buffett is buying and selling at any point in time. There's lots of different portfolios, and you don't know exactly what they're doing at one point to another. People also invest for very different reasons. They might have a withdrawal or moving some money into something else. And I think of the times when we've made strategic changes in some portfolios, often you've just got a whole lot more money in, or somebody shifted money into another portfolio. So paying too much attention to what one other player is doing we don't find that very helpful, given that there's 1,000 players buying and selling on the market every day. But I think banks are value. They're less than 10 multiples, very nice dividend yields, and the big ones are good balance sheets, and currently getting a really nice benefit from the increase in interest rates. And we've just got to watch to what extent bad debts offset that. But banks are cycles, and that's why we're bank analysts analyzing them day in, day out.
Sticking with the banks, one little question. Is there not a big risk to US banks with the depositor outflows to money market accounts?
Yeah, so that's a lot of what was behind SVB, as Lelethu was saying. They've invested their money in bonds at 1.6%, and their clients are now expecting 5% because the JP Morgan money market fund's giving 5.2%. So that is a big factor. I think the bigger banks with big corporate franchises, there's a lot of sticky money there. So, I picture our banking relationship and the money that we got in the bank. We're not moving somewhere else because it's transactional. So there's a large proportion of the cash that's pretty sticky and isn't going to go anywhere. But it's, these banks are diversified players. If you look at JP Morgan, they make their money from 6 or 7 key different spaces. And one part will come under pressure. There will be quite a bit of the money that's was just sitting in a bank deposit that they can pick up in money market. But then they've also got a money market fund that's making an asset management fee off that. So it's not a zero-sum game. But as I showed you on that slide, the net impact of what's going on, you pointed out one of the negatives. The positives are outweighing that dramatically at the moment. But that's what we keep an eye on.
Yeah. Neil, if I may just add to what Peter said, what I said in our fixed income universe is, if you look at what underlies the fund, because the fund receives a lot of investors from a variety of sources, but the fund's then got to go and actually lend that money out. And our portfolios are sitting close to 50%, 60% invested with the major banks. So you're going to probably find something very similar with the JP Morgan money market fund, that it's not a case that the bank's liquidity line has dried up. I think the nature of the liquidity to the banks has changed. I think that the banks themselves will potentially need to pay a little bit more as such, and different banks will benefit, but there's going to still be a strong availability of liquidity just from an alternate source.
Okay. Switching away from the banks, a bit more local. Do you think the new Employment Equity Act is a negative factor for SA Inc. shares? I'm going to ask you that question, Peter.
Well, I'm not sure there's really a new Employment Equity Act. There's lots of different acts and lots of additions and changes. I think the substance of what one's got to do hasn't changed dramatically. So that's, this is not new. I think companies, and especially listed businesses, have to have 5 and 10-year plans. And I think it's all part of being an SA business. So I think it has been a negative for SA businesses. There's a social imperative and the right thing to do. The negative is, I think it stopped some foreign investors investing in SA. I think that Starlink example the other day, where they haven't expanded into SA, And the speculation is that they're not ready, they haven't got their heads around giving up 30% to a local. But I think locals all around the world, especially in the commodity space, where the countries and the communities effectively own the minerals in the ground. It does make a lot of intuitive sense for them to leverage off that and be part of the equity equation. So I think it's probably slowed SA GDP growth down a little bit. I think hopefully, and it's kind of unmeasured, you start to see the benefit on the other side with wealth being created, because it's, and kind of spreading out the wealth of the country. So, that's got to have a lot of positive impacts from an economic point of view. I think if you to measure it from a mathematical point of view, the average BE deal out there, as a ballpark, if there's a 10 to 20% effective equity economic interest, generally there's money loaned into that. There's some interest earned, and the equations that these very clever corporate finance guys come up with is a range of between a 1 and a 5% dilution in the equity value of the business, which many of the companies would argue is offset by the benefits that come from that. So it's part of the SA reality. It's part of having to address the history of South Africa. Mathematically, probably has slowed down GDP growth, but what's probably isn't measurable is the benefit on the other side.
Thank you. Nick, over to you, seeing as I haven't had a question for you yet. Something a little bit more esoteric, maybe. Nick, what's your view of the metaverse? Storm in a teacup or exciting theme?
You know what? I think the metaverse is kind of, so if anyone's watched, what I would say if you want to get a handle on what the metaverse might be, is watch Ready Player One, which I think is a Disney movie. If you watch Ready Player One, you get the idea of what the metaverse might be like. The metaverse, sitting where we are today, where there's war in Ukraine, inflation, all of these horrible things going on, it seems like this kind of sort of utopian idea that sort of was like a 2020 type idea that everyone was, when everything was going up and there was excess liquidity and all of that stuff. It seemed, okay, the metaverses could be like a $1 trillion opportunity. As we sit here today, it just seems kind of fanciful and kind of ridiculous. And so the truth is probably somewhere in between. And Mark Zuckerberg, I think, recognizing that and recognizing the feedback from investors, has said, okay, we still believe in this metaverse idea, and for Facebook, it's potentially existential. So we need to invest behind this idea long term, but not at the cost. We can't completely trash our results for the next 10 years in pursuit of this. So I think it's an interesting idea. I think, but it's so long dated, sort of seven to 10 years out, maybe minimum, that I don't know what you do with that today. So I don't think it's incorporated in Facebook's Meta's valuation, really. So I don't want to be deeply cynical about it. Most people are deeply cynical. I think maybe there's something there, but it's sort of so far out that it's actually not worth spending too much time thinking about.
Nick, what happens if you chuck a bit of AI into the metaverse? How does that change things?
Well, then we should put Facebook on 100 times multiple.
Yeah, I think so I was watching a Bill Gates interview the other day, and he's been at the forefront of ChatGPT and OpenAI and been working with them for the course of the last few years. And he was saying he found it very interesting that the things that he thought would take another 2 years to happen in AI happened a lot quicker. So his own expectation, being at the coalface and having gone through the whole advent of the internet, he played a massive role in the invention of it. I think the pace of acceleration is increasing, and I think what one shouldn't ignore is, that suddenly things can pop up, and there's a lot of stuff being worked on in these big tech companies that are under wraps and suddenly pop out, and ChatGPT is an example of that. And while you've just got to have some exposure, as and you see that in Nick's fund, into the companies and trends of the future. But in a way that, if it is slower than expected, you don't get murdered from a share price point of view. and your entry point is one that isn't factoring in absolute blue sky.
Thank you. Seleho, one for you. Resources took a knock this year. Is the commodity play over until the next cycle?
Yeah, I think the key always with the resources is to look at to differentiate and specify which commodities you're talking about. Because if you look at, for example, the gold part of the resources market, that hasn't been killed. But yeah, in general, it has been a tougher 2023 for resources. I would say longer term. So in the short term, you're always going to have volatility, but in the longer term, there are certain commodities that we think have quite attractive demand supply outlooks. One that always comes to mind is copper. The basic idea behind copper is that potentially by 2030 or around that time, we may not have enough of it as a globe. And it's a really fundamental metal for transitioning the world's economy to a greener, lower carbon economy. So I think that's a good example. But in the short term, I think we're going to have more, I would say, volatility. And there isn't, I don't think we're in a situation where we have a secular growth story over the next, let's say, 2 to 3 years in most of the commodity space. So I think it's more of a cyclical situation. I hope that answers it.
Thanks, Seleho. We are over time, so I'm going to just pose 2 more questions and then we'll wrap it up. Firstly, one for you, Nolan, and then one for Peter. I'm going to ask you both the questions. You can go after each other. For Nolan, currently cash is hard to allocate. It's from Richard. Where would you allocate the bulk of your cash holdings? And would you be phasing in over a particular period or not? And then Peter, question for you is, what's your view on the local share that has the most optionality at the moment?
Nolan, you go first.
I'd like to grab this one first. Thanks, Peter. Cash, to answer that turn around, would I phase into cash? No, I wouldn't. Doesn't make sense to phase into cash because ultimately you're investing to earn a little bit of interest income every day with very little market value changes. If there are no market value changes, no point in phasing it. Looking at cash, where would I allocate cash? Domestically, Anchor, BCI Core Income Fund, you're earning 9 and a little bit percent, maybe 9.1 or so. And actually, that's just a great income yield and cash is readily available, very steady returns. If I'm allocating abroad, where would I allocate? I'd probably put the bulk of it into a money market fund like the JP Morgan Money Market Fund we mentioned. And on top of that, I think I would definitely hold some of the Anchor Global High Yield Fund for a portion of it. A little bit racier than a pure money market fund, but it's still generating a little bit more return, which is fantastic. And your market volatility should be reasonable in most scenarios. So that's how I'd manage my cash holdings. Peter, over to you for the share.
Yeah, so I think we're talking from a local point of view. Obviously, from a global perspective, there's a lot more, you've got a choice of hundreds and hundreds of shares. The dynamics of the local market are such that there's probably 60 to 100 investable shares. And when you're talking optionality, I think one's also got to differentiate between share price and business. So I think a business that we think looks amazing and can double or triple in size, that's Stadio. So that's the distance education business whose major competitor is UNISA. So I think a good product range, well priced against a government institution that is going through similar issues to some of the other government institutions. Then I think from a share price point of view, great quality business. It could be a buy target sitting at a 6p multiple is AECR. Some very nice drivers and some positives behind it. And we actually a bit puzzled about its share price action, which has probably got more to do with liquidity and negative SA sentiment than anything else. And then one, a share price that could double or triple is Renogen. And that's largely because of the stage of life cycle. So Renogen is a world-class and size helium and natural gas deposit. Lots of the positives of shares, kind of everything to do with climate change and the like. but it's got to raise a lot of capital still. It's got to raise 10 billion. It's built one small plant with R1 billion. It's got to raise and spend 10 billion rand on its kind of key plant. And the market is nervous about that. And that's seen the share price come down. I think it got close to the 40s and sitting at 18. So if there's an announcement there about the conclusion of capital raising or success with the New York listing, that's a share price. It's high risk, high return. If they can raise the capital, that thing's worth at least double the share price. So that's just some interesting plays. But I think with all of these, understand the risk that one is taking. And some of them you're betting on an event, some you're betting on the business, and some you're betting on the valuation.
Brilliant. Thank you very much. And thank you very much for everyone who joined us today. And thank you for all of the presenters. I hope that you found the information that we shared with you to be of value to you and your clients. And as always, if there's anything that we can assist you with, please don't hesitate to contact us. Have a wonderful, wonderful week and enjoy the holiday.